Good afternoon, everyone. It is March 10th of 2023, and we're certainly glad that everyone could join us today for this week's market update. Now, I do have a bit of a confession. We're sending this update, we recorded this update on Wednesday, and only because my wife is expecting our second daughter on Thursday, so I'll be offline Thursday and Friday, but certainly if anyone has any questions or concerns, you can email me. I'll be responding to emails, probably with a little bit of a delay, and then back next week, we fully back online next week. So now, as it relates to the market and what's been happening there, we certainly had a really strong week last week, and then this week we've kind of returned to some of this chop, right? So a little bit of down, a little bit of up, and that's not unexpected. We've been saying this for a while, that we continue to expect the S&P 500 to trade in a bit of a chop zone as we get reacclimated to that high interest rate regime that the Federal Reserve has put into place. And we're going to go through all of that this week. In fact, the title of our presentation is, Can Inflation Make You Money? And the reason why we're asking that is we do expect some sticky levels of inflation between that 4 and 5% level longer term to stay with us. Like, we don't expect inflation to just plummet back to 2% and be back to where we were in 2017 in a heartbeat. So we want to understand what are those types of assets and sectors and stocks that can do well and increase earnings and have great pricing power, and ideally have stocks that can rise faster than the rate of inflation to give you real asset growth over time. So that's what we're going to go through this week. We're going to start with that trading setup as we go through mid-March. What I will say is the seasonality of the stock market in March, April, and May is quite favorable. And so we can see here the blue line is what of course, this is all going to based on when you've had a negative calendar year return, what are the seasonalities of the year following that, right? So we had a really bad year in the market last year. What are the seasonal aspects of market returns that following year? And we can see here February is choppy, right? In fact, it's usually somewhat consolidated or even down, and that's what we experienced last year or last month with February. Now we get into that more seasonally strong period of March and April, as we can see here in the chart on the left. So from a seasonality standpoint, we're starting to get some tailwinds as it relates to March and April before re-entering consolidation in May and June. Does that mean it's a guarantee? Of course not. We've been through an extraordinary period over the last 3 years, but nevertheless, we want to point that out from a statistical standpoint. Blue chip portfolio. So where's the market at? As we said, we had this correction in February after a really strong January. We were expecting that. As markets bottom, it's important for markets to take a breather as they adjust to higher levels, consolidate, and then push higher. What we are seeing is that underneath the hood of the market, we're seeing the largest components, such as technology, start to correct again, while the older areas of the market, such as industrials and commodities and energy in particular, are starting to find their footing again. And so this year is not going to be a monolith of, S&P 500 is going here or there. It's really going to be about the S&P 500 market share as former leaders such as technology and consumer discretionary and growth stocks cede market share back over to the value areas of the market. At least that's what we think is in the process of happening. And right now, of course, we are absorbing some of those higher rate expectations. And we saw that, obviously Tuesday in particular was a fairly ugly day in the market. And a lot of that was with what Jerome Powell did and said as it related to rate expectations. So his bottom line message, the economy is coming a lot stronger than expected. The labor market continues to be tight, things that we've been saying and pounding the table on over the last 5 or 6 weeks. And that's going to mean higher than expected interest rates. Now, we, of course, think that inflation is being driven by a number of factors, and that a strong economy is not a bad thing, right? And we're going to go through the areas that we think will benefit from that particular point of a stronger economy. But overall, the Federal Reserve is going to consider, and looks like the market is pricing in, a return back to those 50 basis point rate increases, and then leaving that terminal rate or whatever ends up being that last rate hike higher for longer, right? So whether that's 5.5, 5.75, or 6%, the idea is to leave it at that higher rate for a longer period of time to basically wring out inflation from the system. And we can see there, Tuesday, this chart here on the left shows rate hike expectations went from about 1.2 hikes to 1.6 hikes, and market came down as a result of that. And a lot of this is related to service level inflation. So wage growth as it relates to restaurants and those types of areas within the economy. That inflation has remained rather sticky as that headline inflation has come down over the past year. What does that translate into? Higher rates. So that's just something to be aware of. And we've seen that not just here in the US, but across the world. German 2 years, Canadian 10 years, Spanish 10 years, Italian 2 years. All across the board, we've seen those 2-year rate hike, those 2-year yields go to cycle highs. And we're seeing the same thing here in the US. In fact, the 12-month US T-bills reached above 5%. For those investors in our enhanced income, you got a pay increase last week. So we actually swapped all of our 2-year notes for 1-year notes, and we're able to increase the overall yield on the portfolio by about 25 basis points. So for those investors in our enhanced income, you got a pay increase. For those investors that are interested in our enhanced income, give us a call. We have about a running yield right now of about 7.25% and no stock market exposure in that particular strategy. Now, there are important shifts that are taking place underneath the hood of the market. One interesting thing is that since the stock market bottomed in the fall, the S&P 500 relative to gold continues to struggle. And that's not something we typically see during a bottom in the market. This is suggestive of a more sticky regime of inflation where hard assets will we think will outperform soft assets or financial or paper assets. So what works during inflation? So what we did is we looked at a study and said, when we look at PPI, which is a measure of inflation, what are those sectors that have the highest correlation to inflation? So if inflation goes up, those sectors go up, or if the inflation goes down, those sectors go down. And what we see here is that energy, basic materials that include gold, copper, iron ore, et cetera, real estate, and industrials are the 4 sectors that have the highest sensitivity to the rate of inflation. So in other words, they tend to perform better during times of high inflation. Energy and real estate in particular has the highest hit rate. What we have noticed here, whether it's in Southern California or other high price markets, is that real estate is actually finding its footing again. And that's something that we're starting to pay attention to. Our biggest overweight is energy in response to this sticky inflation and basic materials, and a smaller exposure there as it relates to industrials. Now, we've seen inflation expectations as represented by 2-year break-evens start to spike again. Oil has a very tight correlation to this, and we expect oil to catch up to this 2-year break even. So that's something to pay attention to. The stocks in the sector, I think, are trying to tell us something. While oil has come in over the last 2 to 3 months, the stocks have continued to act great. And we think the stocks historically lead the commodity. So we're going to keep an eye on that as well. Energy valuations are incredibly attractive. So when we look at the S&P 500, trading at about 16.1 times earnings. When we look at FANG, so that would include Facebook, Apple, Netflix, Google, almost 23 times earnings. And that's why we actually are really encouraging investors and clients to stay away from technology for now. We think there's a deeper unwind taking place as it relates to positioning, valuations, earnings, all of those things we think are going to continue to wind down here. Where is energy trading? 10.5 times earnings. And if you look at most of the stocks that we own in the portfolio, they're actually trading underneath 10 times earnings. So that's another thing that we like about energy. They're historically cheap. They're growing their earnings by a substantial amount, and they offer a great inflation hedge. The other area, materials, and within materials and industrials, we're focused on the steel names. And when we look at the steel names from a historical standpoint, they're trading near 52-week highs in a very tough market. And we think the market is trying to tell us something about leadership change. But then also when we look at the steel names going all the way back to 2011, it really looks like they're coming out of a 10-year base from a technical standpoint. And that's something we love to see as well. So the three big things, rising interest rates and stubborn inflation, we think are going to lead to three key themes: that China reopen and U.S. infrastructure spending. That's huge as it relates to industrials and materials. We're structurally short in terms of supply of things in the ground, such as oil, such as copper, such as iron ore. And these things take years to respond to rising demand. So that's where we're positioned from that standpoint. And of course, the emergence of India as a source of massive demand for commodities. When we think of that 2000 to 2010 commodity boom, we think of China. When we think of this time around, we think of supply shortfalls plus the emergence of India as sort of transitioning to an industrial powerhouse the same way China did 25 years ago. So energy, copper, iron ore, plus industrials, we think those are the areas well positioned to take advantage of these three key themes. As of course, we've saying this for many weeks now, old economy over the new economy. The stocks are cheap, earnings are improving, they're under-owned and maligned across Wall Street. And we think that technology and the old economy stocks converge as it relates to the S&P 500 weight. So bottom line, that market chop continues. Important themes are forming and do represent leadership change. Few quick things here. Market pullback does remain organized. We are entering into some better seasonality, so something to be aware of there. Interest rates are heading back up. 2-year yield at cycle highs. That will act, or we think will act, as a growth on as a headwind on economic growth. And then lastly, energy, materials, and industrials we think can act well in this type of inflation tape, and it can act as a hedge against inflation, but also are well positioned for those three secular themes that we talked about as it relates to the China reopen, U.S. Reindustrialization, and of course the emergence of India. So if anyone has any questions, concerns, please feel free to email me. I'll be offline for the next couple of days, but after that we'll be back to being 100% online. So hope everyone has a great week, and we'll talk again next week. Have a great weekend and a great day. Talk to you later. Bye.